It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I'm your host. I'm also one of the certified financial planners on the program. And with me in the KFG studios, Kevin Korhorn and special guest health insurance expert Ben Bolgreen.
So when retiring, you're eligible for Medicare at age 65. But what if you're planning to retire before 65? What are your options for health insurance then? And are there some common mistakes you need to watch out for? We're helping with that and more on this episode of The Wise Money Show.
That's right. That's right. Lots of questions related to health insurance. It's the biggest health insurance decision you're going to make in your life, most likely, is when you transition from your workplace retirement plan either onto Medicare, what your choice is there, or if you need to make a stop with different health insurance before Medicare. Huge decisions, lots of questions. You need to be working with an expert, but we're here as well. You can reach out to us, leave questions on the website, wisemoneyshow.com. All over social media, wherever you're at, we are there as well. Or you can call or text us 574-222-2000. All right, Ben, thanks for being on the program. This is a common topic. You can retire early. Is it difficult? Yep. But can you do it? Yeah, with proactive planning and having a powerful vision. And part of that deals with, well, what's your vision for health insurance? You need to make sure, whether you're actually looking at retiring early or retiring right at 65, you do need to have your health insurance decisions baked into and sort of pre-planned as part of that retirement projection. Otherwise, you might not be planning appropriately or correctly. Kevin, so expand on that, or how do we make sure that health insurance is part of that retirement planning discussion and equation?
Well, you want to have a 5-factor retirement plan, and you want to specifically identify what are my assumptions related to my health insurance. And this is where you want to work with a planner and make sure that planner is certified, but also make sure that planner has an integrated solution for helping you with this decision. And it's a little bit tricky because as I am getting closer every year, I think, wow, it's totally different. I am going to be signing off of the traditional, the institutional program that I'm used to, and signing up for a completely different program. And what are all of the things that I need to know? And it's difficult, especially if you say, well, wait a minute, I'm one of those guys that when I get a box to assemble something, I open it and start assembling, and I don't really enjoy reading the instructions. Yeah. You definitely want to look at the owner's manual for the different choices you're going to have before 65, and then what do you do at 65?
And you've got to bake that into your retirement projections. It's part of, Kevin said, the 5 factors. It's part of the second factor. How much are you going to spend? How much are you going to spend? And specifically, what do you think health insurance is going to cost? That's got to be baked in there. The informal or off-the-cuff retirement calculators of, oh, you're only going to spend 78% of your current wages. That has nothing to do with your health insurance. Where in your current wages are you paying for health insurance? If you're on an employer-provided plan, they're paying something, and then you're paying a little bit. That's not connected at all with what your take-home pay is or what your gross pay is, and therefore, a lot of people overlook health insurance as an expense when they're planning for retirement, and it ends up, it could cost them significantly. So, all right, but focusing on the story problem, retiring early, whether that is 64 or whether that is 54, right? Medicare, for the most part, you're eligible at age 65. A couple unique circumstances, health circumstances, where you could be eligible sooner than that. But let's say Medicare starts at 65, but you want to retire sooner than that. Ben, what are your choices? First one seems like COBRA. You've got to consider that. So what's COBRA? Let's dive into that one.
Yeah, so we'll bring that back even to what you were talking about, Mike, earlier, of through an employer-based plan. Typically, the employer is paying a portion of your health insurance, whatever that is, and then you would be paying a portion of that. COBRA is the continuation of the exact same plan that you would have had through your employer, except there is no employer offset anymore. So it's the same medical coverage, but the cost is going to be 100%, but not 100%. It's going to be 102%.
Yeah.
So you're paying your amount, what your employer previously was paying, and then an additional 2% to cover some administration fees.
Yeah.
So it's going to feel like a worse plan because it's the same coverage. You're just paying significantly more than you had in the past.
And sometimes I know I mentioned, when you're planning for retirement, you have, you can't really fully see what you're paying for health insurance. Some employers, you see what's coming out of, your contribution. Yeah, most of them you would see that. But then some of them, you can see what the employer is paying as well, right there on your pay stub because they want you to be able to see that. But I would say maybe 50% of paychecks have that detail on there. For everyone else, it's just a mystery.
Right.
And how much is like the first question of, COBRA is an option. Let's explore that. Well, how much is that going to cost me? For many people, it's a mystery. You got to reach out to either your benefits or HR team to get that answer.
Yeah, absolutely. And one thing that we would want to pay attention to with COBRA as an option as well is it is a temporary solution. It is, in most cases, 18 months of coverage. So for 64, that could be a great option. For 54, it could still be an okay option, depending on what your plans are otherwise, but it's definitely not the option from 54 to 65.
Yeah. Okay, so pros and cons of COBRA. What would you say some of the advantages are, some of the disadvantages?
Pro is that it is the exact same plan that you had been covered by. And so if you are in the middle of the year and you have already had some type of health expenses, you've had some type of surgery, procedure, anything like that, that will carry over with your plan through the end of the year. So if you fit your deductible, if you fit your max out of pocket, it could lead to lower medical costs, even though your monthly premium is potentially higher than you could find otherwise.
Oh, that is interesting. So say you're looking to retire. I have a lot of people that choose to retire in the spring or early summer, like right now, because they want to enjoy their summer and they don't want to have to worry about work and all that sort of stuff. Well, if you've already had a surgery, and we also hear about this. Hey, I'm about to retire. I want to get this surgery done. I want to get that knee replacement done or whatever. So if you already hit your deductible,
Right.
if you switch to a different plan when you retire, that deductible doesn't carry with you.
Right.
But even though COBRA might on a monthly basis be more expensive for the next 6 months or till the end of the year, it might make sense to stay on it because your deductible's already met.
Exactly. That's correct.
And this is why you want to sit down with someone who knows it inside and out, because there are things that can be seen that aren't obvious.
Yep. Okay, so keep going. Pros and cons.
Another pro is that, again, it's your same plan, which means that the doctors that you are seeing, you can continue seeing them. There's no question about that.
I was going to make a joke on there. Can you keep your doctor? Yeah.
So a con to that, though, is, as we've already mentioned a couple times, it can be expensive. It can be much more expensive than alternative options, and that's where we need to make the evaluation. Does it make sense to pay for that added benefit or not?
But the beauty is you're doing it on your time and on your timetable. So you actually, one of the little known things is you can have 60 days of coverage. And if there are no claims during that time, you flip onto your new coverage and you're basically covered without having to pay for it.
That's right. Yep. Something that we try to talk with our clients about is, are you expecting, if it's not a retirement, if it's a job change, are you expecting to get other coverage and sometime soon? And then maybe we just hold off. If the other piece with that, though, if something were to happen, exactly like you're saying, Kevin, you would pay the full amount, but there would be no gaps in your coverage. So it allows us a little bit of flexibility to plan for what's coming next.
So how long is it? Is it 60 days?
60 days, yes.
And that's whichever employer you have. If COBRA is offered, no matter who the company is,
yes,
you've got 60 days to sign up.
Yep.
Yeah, interesting. Okay. Does a group plan have to offer COBRA?
If an employer has 20 or more full-time equivalent employees, then yes. So that'd be another thing to consider. I always ask, hey, have you been told that you're going to be offered COBRA? And then we follow up, well, if this is your situation where there's 20 or more, then you will be. But I always like to double check as we're talking through those options.
Yeah. You talked about, one of the cons, already mentioned it, but it's temporary. COBRA is temporary. In many cases, for termination of employment, 18 months is the max you can get.
Yep.
But in some situations, divorce or death can be up to 36 months. I
Correct.
think
Yep.
there's a range. So you want to know for your specific situation what is that range. But yes, temporary, that is a con. My question is, it used to be COBRA was the default. Now it's just one of the choices. How popular is it? What are your other choices? We've got that and more coming up on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern time every Saturday morning. Also on podcast at the same time and also on a couple of local radio stations at the same time as well, which is why the content's an hour and why it is broken up into different segments. Like right now, we're at a commercial break for the radio. But if you are interested in more content that will help you take your next wise step in your financial life, tackle whatever financial circumstances you're facing right now. We've got lots of content here. Videos air all throughout the work week that I'm certain if you've got a financial issue, we've created some helpful content about it. So make sure you hit that subscribe button. Turn on notifications so you're made aware every time we drop new content. If you like the content, you can share it there as well and leave questions also. Thank you very much. I'm curious if you're watching right now and you've already retired or transitioned employers before Medicare. What'd you go with? Did you go with did you go with COBRA or did you go with something else? Curious. So I want to start with that. How popular is it still? And then we can get into ACA. Was there any other points you wanted to make sure to drive home on COBRA?
It is just the piece that we mentioned at the beginning of it is not a qualifying health plan in Medicare's eyes.
Yep.
But I don't know how that has happened one time for drug coverage for me since I've been here. So I don't think it's all that typical.
Good to point out. Good to point out.
Yeah. So, and this is interesting because I was looking up, okay, do I have to offer COBRA if I'm an employer? But if your prompts aren't accurate, you're not going to get accurate data. Because I said, I've been doing this COBRA string, and then I said, does an employer have to offer coverage? Well, ChatGPT hopped off of that thought train and said, large employers 50 plus must offer a minimum essential healthcare health insurance to at least 95% of full-time employees and their dependents. That's not the COBRA question.
Right.
The COBRA answer is 20. The healthcare question is 50.
Yep. Yeah.
So,
all right, here we go. Picking back up with COBRA, and then we'll go over to exchange. Does anyone call it the marketplace anymore?
I do. Marketplace, Healthcare.gov.
I knew I liked you, Ben.
no, hey, Mike, the thing that you didn't do was promote our guide. So when we were talking about the 5-factor retirement plan,
am I the only one that has to promote it?
Well, no, I was
the only one with a microphone.
I was gonna jump in. You were flowing, and then you flowed right into Ben, and Ben started rocking, and I'm like, okay, I'm not gonna go back and do it. But I do think, even for the folks listening right now, if they said, I just need a resource, can you point me in a direction? Where would you point them?
Well, yeah, I mean, getting started, laying out. So the 5 factors of your retirement, these key decisions are all interrelated. So making a decision, you can't say, I want to retire at 42, but I want to be able to spend $100,000 a month, right? I mean, so all of these factors are interrelated. So you need to start by laying out what your choices are or what your decisions are. And that is something you can do with our guide. You can go to wisemoneyguides.com and download it. And then that'll get you started sort of mind mapping what are some of those assumptions that you would make for your ideal retirement, and then working with the CFP, you can stress test that, and it'll get you going on the right track.
So if I'm listening right now, where would I go?
wisemoneyguides.com.
wisemoneyguides.com. Could I get there from korhorn.com?
Not yet. You will be able to.
You'll be able to.
Okay, there you go.
All right.
Eventually.
Second segment, we'll start with COBRA, and then we'll get into the marketplace. There we go. If you want to retire early, you can. You can build that plan, work with your certified financial planner, work through those 5 factors and do what it takes. You can get there. You'll need to figure out a bridge to Social Security and health insurance before Medicare. We're sharing those options right now. This is the Wise Money Show with Cohorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Cohorn, special guest health insurance expert Ben Bullgreen. Every episode of the Wise Money Show is on podcast. Wherever you listen, just search the Wise Money Show. Subscribe to it there. Rate the program there as well. We appreciate it. And last thing I want to mention, go to wisemoneyguides.com. We're talking about health insurance, but basically retiring before age 65. This is one of the factors of the 5 factors of your of a confident retirement plan. So get started on building out those 5 factors for you so that as you work with a CFP, you've got those trade-offs that you can make and build a confident retirement plan. wisemoneyguides.com is where you can go and get started.
And you can click on that in the show notes.
There you go. Where we left off, talking about COBRA. This used to be the most popular choice. If you were going to retire before Medicare, COBRA was like the one and only primary stop. How popular is it now, Ben? How many people are taking COBRA?
Well, and before Ben answers that, I had a client that worked for a large regional grocery store chain, and he was in management. And when he left that job, he thought, well, I'll just take COBRA. I'll just hop on COBRA. I can continue the coverage that I have. There was going to be a decent gap in between what he was doing and when he started his next job. And their coverage was $2,400 a month because he was paying, I don't know if he was paying $100 or $200. I mean, it was not very much money at all. And all of a sudden he looked and he's like, well, the actual coverage is $2,400. I'm not doing it. And so what we did in that case was we just got a short-term catastrophic medical coverage policy, just a gap filler. But he was younger. He was in his early 50s. That's very young.
So I'm almost hesitant to say, because I don't want to scare people off from COBRA as an option, because for some people it really is the best option. But for the people that I meet with, it's maybe 5%.
Yeah.
That is, we can't find an alternative that meets their needs a little bit better.
Yeah. Yeah. And there are, again, we've mentioned some of the benefits, some of the, cost-wise and other things.
It feels like if you're going to you need to know if COBRA is an option. And planning is all about understanding your choices and having as many choices available as possible. And then of those good choices, picking the one that's great, the one that fits best in your situation. I don't think you can, COBRA is an option, that's all I'm doing. You need to explore the second option and the third that we're going to get to. But Ben, anything else on COBRA? Anything else that you just want to make sure people are aware of how COBRA works?
So we've said a couple times that this is the exact plan that you had through your employer. One thing to keep in mind is that when you would become eligible for Medicare, you could delay signing up for Medicare and avoid any penalties if you had a qualifying health plan. If your employer plan was a qualifying health plan, but you are on COBRA now, in Medicare's eyes, that is no longer a qualifying health plan. So that would be something to jump on as Medicare would get even closer.
Make that make sense to me.
Yeah, I know.
It doesn't make any sense at all.
No, I know. I heard words, but it means nothing.
That is unbelievable.
The same plan, but for whatever reason, Medicare has made the decision that no, this is not going to prevent you from accumulating penalties if you don't sign up for Medicare when you're first eligible.
Right. So if you're into delegation at all, go talk to a pro.
Yeah. My goodness. All right. So even if COBRA is an option, even if you've said, yeah, that's what I'm going to do because I want to keep my same benefit, I want to keep my same doctors, I know what I got, I'm comfortable with it, even if I have to pay, twice as much or 3 times as much what I'm seeing coming out of my paycheck, I'm going to do it. Before you make that decision, you got to at least consider option number 2, and that is Affordable Care Act or Marketplace. I think most people are just calling it Healthcare.gov, which is the website you go to. But Ben, what is that? And then we'll get into pros and cons and how it works.
So it is an exchange, a marketplace of options for insurers and insurance plans that you can enroll in through special periods of time throughout the year. One of those times would be as you would leave an employer, you would qualify for a special enrollment period to join these marketplace plans. And it is going to have similar setups to the employer plan. There's going to be a monthly cost to you in the form of a premium. There's going to be costs when you go to the doctor in the form of copays. And then as you would get treatment, co-insurances or a percentage of whatever the cost of your treatment would be up until the deductible or max out of pocket for the year.
Do you get to keep your doctor?
Maybe. So one way that we would try to identify that is we'd have a list of the doctors that you would want to see, and then we'd enter that into the software, Healthcare.gov, the enrollment software that we use, and it would tell us if your doctor's in that plan's network or not. And there are usually 60 or so options, as many as 100. So that can be good.
Yeah.
It can be overwhelming as well.
Yeah, I mean, there again, you want to have a guide. You want to have someone that's an expert that's helping you. Same with prescriptions, right? I mean, for that discussion, when you're talking, when you schedule a meeting with Ben or a member of the team to sit down and review your choices, you're going to want to have a list of your doctors as well as a list of your prescriptions. And I can't spell mine. So whatever it takes, you're going to want to have those. So then you can evaluate, well, what plan is the best one for my specific situation?
Yep, absolutely.
Yeah. Okay, so this is Obamacare, Marketplace, Healthcare.gov. Pros and cons.
One of the pros, the Affordable Care Act, the intention of this is to make health insurance more affordable for more people. And so one of the pieces during the application process is we would enter in a projected household income, entire household income, for the calendar year that we're looking to be covered by. That would potentially qualify an individual for an advanced premium tax credit or a subsidy, an amount that would come off of whatever the full price of the plan would be. Yeah. So that can be a pro of this plan. It can actually be an affordable option for a lot of people because they are not paying for the full price of their plan like they would in the COBRA situation.
Okay, so you were very precise in your language because you hit a lot of the normal speed bumps or booby traps or whatever, but it is household income, and it's for that calendar year. So most people think, well, I worked until June and I made $1 gazillion, but now I'm retiring and I'm not yet I'm retiring early, so I'm not even turning on Social Security. I'm just going to live off of the money I saved up in the bank. And so my income from this point moving forward is going to be really low. So I'm going to put in a low number there. No, it's calendar year income. Or they think, oh, my spouse is still working, but I'm not going to have any income, so my income's going to be zero. No, it's household. It's capital gains and it's dividends. It's the whole thing for the whole year.
So that is where the planning piece comes in. To Ben's earlier point, you might want to ride out the rest of the year on COBRA because it could possibly be cheaper. And then once you have control over your income the subsequent year, you can say, all right, now I'm going to get on a marketplace plan. Just to give you some frame of reference, because if you've been listening and this isn't making a lot of sense, a couple earning $50,000 might pay less than $300 a month for a silver plan that normally costs $1,000.
And that's from actually tax credits, but advanced tax credits that are applied to your premium to make your premium lower. And therefore, if you're paying $300 instead of over $1,000, you're getting that tax credit in advance. If your income ends up going up higher than $50,000 because you had a dividend or you thought, oh, the stock market just went back up, I'm going to sell this investment, or you know what, we need to buy a new car, I'm going to take some money out of my IRA, all of a sudden your income goes up when you report, when you claim, file your taxes. Your income's going to get, sort of worked out in the wash right there. And if your income's above what you said it was going to be, guess what? You got to repay those tax credits.
Yeah, those are difficult conversations.
And we've said before that if you're on Healthcare.gov, if you're getting your health insurance through a marketplace, you have to work with a certified financial planner.
Yes.
You have to do proactive tax planning. Tax planning has two goals, okay? Capture opportunities. Oh, and are there opportunities to make sure that you get as many tax credits as possible for the health insurance, but avoid surprises. And if your income doesn't come in where you expected, that's a big surprise, and it's a nasty one. And so you need to be doing that proactive tax planning. Tax planning, not tax prep. Tax planning is one of the 6 areas of financial planning, of your financial life, just like investment planning, retirement planning, your present financial position, so cash flow, Protection planning, that's where you might say, oh, health insurance fits there. So it's just this isolated thing. No, it's connected to that tax planning. By the way, estate planning as well. That rounds out those 6 areas. So you need to be working with the CFP if you're on Healthcare.gov. All right, more pros, cons, financial planning strategies. If you're retiring early, that more coming up on the Wise Money Show with Korhorn Financial Group. Okay. We still have a decent amount to hit there, so, and that works. We have had a decent amount of coughing, sneezing,
Dude,
blowing the nose. Like, this has been.
I know.
You need to get one of those. Like one of those.
No, I actually tried to blow and without making any noise, and
Didn't work.
didn't work.
All right. Third segment. We'll pick back up Healthcare.gov at some point. We'll weave over to a network. What do you call those? A share network?
Health share plans.
But it's not. You would call it a plan?
Oh, that's a good point. Am I supposed to call them plans?
I don't know. Health share network.
I would call them a health share network, also a healthcare sharing ministry.
All right.
We do have some
Ministry?
non-faith
Yeah.
ones, but yeah,
Yep. I had
those
two-
are the most popular.
Yeah. Which one?
The ministry ones for our clients.
There's a guy in our church. I had to sign off on his to say that he goes to church. So
Shoot him a text. Where are you? I stopped in, Kevin. Don't take my health insurance.
I'm turkey hunting today. No, that doesn't really count. We're going to change
You
that.
better
health
not
plan.
get sick.
That's right.
All right, here we go. Third segment. If you're retiring before Medicare, before age 65, COBRA used to be the choice. I would say 90 to 95% of folks started with COBRA. Now, it's only about 5%. What do they go with instead? What are your choices? We're helping with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn, special guest health insurance expert Ben Bullgreen. Every episode of the Wise Money Show, as well as a lot of other content, is on the YouTube channel. Go to YouTube, search the Wise Money Show, subscribe to it there. Turn on notifications so you're no matter where every time we drop new content. You can leave questions there. I'm curious. We're curious. If you retired before age 65, what'd you go with? Did you go with COBRA? Did you go with a share plan, which we're going to talk about here in a little bit? Was Healthcare.gov an option? Share that below. You can do that on the Wise Money YouTube channel. All right, so we're into option number 2, and I hate to say, well, COBRA's option 1. Healthcare.gov is option 2. I think they're 1A, 1B, and I don't even know which one I would do A and B. You have to look at both of these before you make a decision.
Absolutely.
Okay, and probably all 3 of them. We were talking pros and cons with Healthcare.gov, and the big pro is that you might be able to qualify for some advanced premium tax credits, do planning, all that. Another pro is there's health insurance available, which, I mean, yes, the original plan, very highly controversial plan, and congressional action there was to try to make health insurance more affordable, but it also was giving people access to coverage, which before Healthcare.gov, when people wanted to retire before 65, that was a bigger issue than it is today. So that's certainly another pro. What other pros or what cons with Healthcare.gov?
So one of the cons is going to be a little bit tied to the pros. The pro is lower monthly premiums. What that typically leads to, though, is higher deductibles. And so as we're comparing what's my guaranteed monthly cost I'm going to pay if I go to the doctor once a year or once a month, the premium is a really big benefit. For most people, most of the time, that's going to be the biggest benefit that they can do is just save those guaranteed dollars in exchange for some higher risk. However, on the marketplace with those lower premiums, the higher deductibles can reach $9,000, which is about double what you'd find on most employer plans. So more risk involved in that. You have to balance out, is the savings on a monthly basis best for you? And we all have crystal balls in our back pocket, so we can make the perfect decision every time.
So I had a kid that earlier this year broke his pinky, And then within a week of getting the cast off, it was a splint because it was pinky, broke his wrist within a week.
Yeah.
And so, yep, you just don't know. So you said higher deductibles. I think health savings account, but you need to be cautious because of the choices listed. Some of them are HSA eligible, some of them are not. And we recently had a situation in our area where a company just said, hey, yep, all these high deductible plans, nope, they're no longer HSA eligible at the turn of the year.
And I think to kind of tag on to that question, because we have listeners all over the country, if you're listening to this and you say, oh, well, the exchange is the same wherever you are, it's not.
No.
So there are certain areas or pockets of the country where you can have incredible coverage, and certain areas where it's pretty sparse, slim pickings.
To that point, we're talking about retiring before age 65. And for many people, you might consider, well, we're moving. When we retire, we want to retire because we want to be either closer to better weather or closer to family and grandkids. How do you navigate Healthcare.gov, getting your insurance there, if you're moving at some point, either right away or planning on moving during the calendar year?
Yeah, so just like leaving an employer would qualify you for a special enrollment period so you could join a marketplace plan in the middle of the year. It's the same thing if you were to move. And that's one thing, to Kevin's point again, the options are different. And so the plan that you have in your state might not even be an option in whatever other state that you go to. So you would have a period of time that you could enroll in a new plan that would cover you till the end of the calendar year. But it would be starting the plan all over again.
Yeah. You mean, so changing deductibles?
Changing
right?
deductibles.
Yeah. Okay, so is the coverage options and your choices based on state, or is it based on county, or is it based on something different, zip code? I mean,
so zip code ultimately.
Yeah.
And the other piece with that, even though there are different options, different companies, different plans, they all have to cover a list of 74 preventive care services in order to be listed on Healthcare.gov. Okay. So that's maybe a peace of mind of pro is, even though they're different, there is some standardization across there. So your annual checkup is included at no cost to you, a handful of screenings, that kind of stuff.
What percentage of the individuals that you work with, if only 5% or 10% are going with COBRA, what percentage are going with Healthcare.gov?
It's close to 75, 80%.
Yeah.
That's when I'm presenting options. This is the one that I start with specifically for those tax credits.
So let me say that a little bit differently. If you are in your career right now and you're listening to this saying, I'm about to turn the channel, I'm not anywhere near retirement, or it's still 5 years away. The decisions you make right now about which tax shelters you're going to fund will influence what you're going to pay for your health insurance if you happen to retire before age 65. And if you say, I'm going to work well past 65, that might be your preference, but you're not fully in control of that. If you have a health change, or your company shifts, or you get downsized, or
your spouse has a health change.
A family member has a health change. You may find yourself in a situation where you need to be done sooner, and all of a sudden, the small decisions that maybe you just put on autopilot and never proactively planned for, all of a sudden come back and cause you to pay a lot more for your health insurance than you otherwise would. This is the case. So what I'm not saying is, okay, fund that Roth IRA and start pulling that Roth IRA, withdrawing from that Roth IRA early. What I am saying is, make sure you have tax diversification. Some dollars pre-tax, some dollars Roth, and maybe if you've got enough resources where you've filled up those buckets, maybe some dollars that are not in tax shelters. And that's what you're living on early in retirement, and getting health insurance at a really low rate. So how long can people stay on health insurance on Healthcare.gov, like all the way up until Medicare?
Indefinitely. We like to talk about marketplace plans like they're 1-year sprints. So because we can change those plans every year during the open enrollment period, November 1st to December 15th, you have options for the next calendar year.
One of the first questions when you go to Healthcare.gov is they ask you, are you eligible for other insurance? Mm-hmm. So once you turn age 65 and are eligible for Medicare, would you have to go on Medicare, or could you still be eligible for health insurance through Healthcare.gov?
So you could sign up for a marketplace plan, but then you would not be eligible for those tax credits. And so that's where the big savings comes with those plans. In the majority of cases, it is much cheaper to sign up for Medicare when you're able to. And if for some reason you're hired and it was more expensive for those Medicare Part B for Medicare, then it also doesn't. A marketplace plan does not count as a qualifying health plan, so they'd start assessing penalties.
Yeah. Okay. Interesting. All right. Let's start getting into option 3, and this is not an option everyone considers. Again, financial planning, you want to look at all of your choices and then make the best decision. But this one's a health sharing network, if you will.
Yep. So what this is, it is not insurance. They always tell me that. They say, hey, you cannot call this insurance. It's not insurance. It's a group of people that you would join up with, and you pay a monthly cost. I won't say premium. It's a premium. And then you would be able to essentially go to any doctor that you'd want to, because what you're doing is you're paying in cash. And then the medical expenses that you would receive, you can submit to that group to be reimbursed.
Yep.
So there's a number of them. There are some that are tied to some faith backgrounds.
Yep.
There are some that require no faith commitment. It just kind of depends on what's going to work the best for that specific person's background.
And how popular are these? Would this be the other 5% or so, if I'm doing the math right, based on your percentages?
Yeah. So it works for a number of people. Somebody who likes the idea, doesn't really like traditional insurance, maybe doesn't qualify for tax credit, so it's another good alternative to COBRA. And somebody with low medical costs, that can be a good option.
And has liquid resources that if there was an expense, they could pay it out of pocket. They might not like it, but could pay it out of pocket and wait for reimbursement. So it's not health insurance. It's only structured exactly the way you would want your health insurance to be structured. And so it is an option. We're going to dive into a little bit more of the details, the pros and cons with the Health Share Network, and then talk about not really an option, but a mistake and an issue. We've got that and more coming up on the Wise Money Show with Korhorn Financial Group.
So the trick is, if you look and say, have there ever been any health share ministry type deals that have failed? You can come up with a list of them. And so there's no obligation to pay claims, lack of financial reserves or oversight, denials based on religious or moral clauses, misrepresentation. Some of them have gotten in trouble for marketing themselves as insurance, potential poor customer service, and billing confusion. But I look at the two biggies. One is, if I have a pre-existing condition, it may not be covered, likely won't be covered. So pre-existing conditions, and I can't do an HSA.
Yeah.
So those are the two things that
Have we had someone with a major medical event on one of those?
Yes.
How's it work?
The one that I am thinking specifically, it did not work.
Yeah, that's the one. That's the other risk
Wait, say it again.
It did not work. Or it worked up to a certain point, and then we switched them to a marketplace plan. And here's the catch for that: the marketplace plan didn't work either. So it was
really?
that.
Why not?
Because of the approach that was being taken towards the care, towards the individual's care. So from my understanding, they were not improving. And if they're not improving through the care that's being given, then the insurance company is not going to pay.
Yeah.
So
it is, and that can get super frustrating. But one of the things that doesn't make sense, and it didn't make sense, at least, certainly to me, until I learned more about this, and like, oh, is that how it works? Health insurance, medical insurance is there to get you better. And if you reach a point where you're still sick, like I look at it simply that health insurance is there to cover my medical expenses. No. It's there to help cover the expenses to get you better. If you can't get better, they're done.
they're done. Yeah.
Is this world backwards? Are we in a bizarre world? Like, that doesn't make sense.
Yeah.
And yet that is how it works. Just like home and auto insurance, how they write those things is, you'd think, well, we cover everything related to these, to claim, except we'll exclude these couple things. No. They're written, we cover nothing except we will cover these couple things. Again, we are living it's a backwards world that doesn't make sense.
And the truth is, most people don't read the fine print, and because they don't need to. They don't need to understand it until they do, and then there can be a problem.
All right, so 4th segment, Land on the Plane. We'll pick back up with the health share networks, talk a little bit more pros, cons, and Kevin, I thought what you said was really good to share on the air, not just as bonus content if you want to. And then at some point we'll pivot to Medicaid, and then any other mistakes, common mistakes you see people make. That probably is going to round out the show.
I'll come back. The majority of our clients that are on the health share plans are very happy with it.
Yeah.
And the only complaint that the complaints I usually get, there's a lot of administrative headache, and I don't use it because there's no preventive built into it.
Yeah.
So I'll share that but.
Okay, cool. All right. Here we go. Thanks for being here. This is the Wise Money Show with Cohorn Financial Group. My name is Mike Bernard. With me in the KFG studios, Kevin Cohorn, special guest health insurance expert Ben Bullgreen. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com, and then all over social media, wherever you're at, we are there as well. Search the Wise Money Show, talking through health insurance options before Medicare, before age 65. What are your choices? How do you evaluate them? And what are the big mistakes that we've seen people make and we want you to avoid? We're going to get into that in just a second. A third option, right? You got to evaluate COBRA if it's a choice, and Healthcare.gov. A third one that you might want to consider, not insurance, is a health share network. We were talking pros and cons. Let's keep going there.
Yeah. So a pro can be lower monthly cost than COBRA specifically. And if you don't qualify for any tax credits, then that can be a cheaper monthly option for an individual. You get the flexibility because since it's not insurance, you're paying in cash. You're going to say, hey, what is your cash rate when you go to see a provider? Yeah. And that typically comes with a little bit of a discount as well. A con for that, though, is it's not insurance, which means that there are no guarantees. And so there is no way that they would say, yep, we're definitely going to cover this, this, and this. It is you would submit the bill, and there are some guidelines about what can be submitted, but there is also the potential that they would deny whatever that claim.
I mean, technically, there's no legal obligation to pay claims. I mean, if we're talking about what are the cons to this, there's a lack of financial reserves or oversight. There can be denials based on religious or moral clauses. There have been a few of these that have gotten in trouble for misrepresentation, so they've kind of held themselves out as we are insurance, and they're clearly not insurance. The two things that I look at that I say that those are kind of deal killers is, number one is if I have a pre-existing condition, they're likely going to exclude that from any kind of coverage, and so that might exclude that as an option altogether. And the other thing is it's not an HSA eligible plan because it's not insurance. So I love funding an HSA if it's at all possible. So if I've got an employer plan that's HSA eligible, or if I go on the marketplace, I want to get, if I can, an HSA eligible plan. And then I'm funding my HSA, and I'm getting some of the tax benefits, the triple tax benefit of the HSA and some other things. So I agree with you, Mike. I mean, this is a great plan for someone who might be super healthy and might not be too worried right now about what do I do about my health insurance. But if there's any chance that you might need the coverage, I might steer away from it.
And that's going to come back to a couple of the cons. For additional cons is that there's more administrative headache to go with these plans since there is no insurance department that is working through the billings. It's you. You're the one that's going to need to to do the negotiations with the company, get the itemized bills to submit for reimbursement. So it is more time intensive on your part. And then the other piece with that is that in most of these plans, there's no preventive care built into them. So when we're talking about healthy individuals, one of the complaints that I've heard about these plans is I'm healthy, but that means that I also don't go for my annual checkup because then I have to pay for it, and I'd rather not pay for it. I'd rather just keep going because there's nothing wrong with me. But then that can lead to some ongoing issues over time if they're not getting those regular checkups.
Yeah. This just continues to go back to if you're planning to retire early, making sure that you're working with a financial planner to map that out, plan appropriately for health insurance, what it's going to cost so that you know you're not making errant assumptions, making bad decisions about when to retire. But part of that is educating you on what these choices are and sitting down with an expert to evaluate which of these choices is best for you. Now, let's turn to some of the common mistakes. And one of the ones that we've seen before and we've talked about is with this tax diversification. If you get to a point where you're retiring early before Medicare, you are not on Social Security, so that income's low, and you're just living off of cash maybe that you've built up. What's your income look like? Pretty low. And there's a chance that Medicaid could look and say, based on your income, you qualify. Let's explore whether you officially qualify. It also, and that can create a strain with Healthcare.gov. Can you explain this danger and this risk or this issue?
Yeah. So the Medicaid and Marketplace or Healthcare.gov, they're on the same spectrum almost. So it is you either qualify for, or maybe spectrum is the wrong word, but you either qualify for Medicaid or you qualify for a Marketplace plan. There's no in between. And so as we're planning around this, one thing that we have come across is Medicaid is a great option for a whole lot of people. What that means though is that your income is low enough to qualify for Medicaid. What that translates to is you have low to no medical expenses, but what that comes with is access to doctors may be a little bit more limited. And so there are fewer doctors that are Medicaid participating doctors. So that might impact what you would hope to be on. And a big piece with the Medicaid picture is there is still some type of stigma or felt stigma of I am on this. And so either doctors treat you differently or you feel like they treat you differently or you feel different because you're on this piece. But again, it works for a whole lot of people. It just might not be the right option for you. But
so let's think of the story problem. You are able to retire early because you have you've saved up a lot of assets, and maybe you manage your expenses well. You've been planning proactively, and you've got tax diversification. So you've got a lot of money sheltered from tax, therefore you don't have dividends and capital gains landing on your tax return, but you've got other dollars that you've saved up that you're living on, and you can keep your income really low. To me, of these three choices of health insurance before Medicare, I go to healthcare.gov because my income's really low. I can get tax credits that probably wipe out all the premium, and I'm in a great spot. But if your income is so low, you can't qualify for both Medicaid and Healthcare.gov. And if you qualify for Medicaid, you're not going to get those premium tax credits. Right. So there's this, Medicaid or Healthcare.gov is saying, no, your income is so low, you should be on Medicaid.
Right.
And then Medicaid is going to look and say, well, your income is low, but do you meet the asset threshold? No, you don't. They're going to kick you back over to Healthcare.gov, and it's going to be this big mess.
Yeah, so there is some coordination that happens between them. As we would apply through, at least the way we do it, through the Marketplace, and then that is going to give us the initial determination. And that determination is, yes, you qualify for this, or no, you should be on the Medicaid plan. Yep. And as soon as it is in Medicaid's hands at that point, they've got a ticking clock. So it's 10 business days or so where they would have the time that they would evaluate exactly what you're saying and then either approve you for a Medicaid plan or send you back with a letter that says, no, actually, you don't qualify for one of these. And then we would use that to enroll. And so it does create a little bit of a uncertainty for a period of time, but it is typically within a month or so. So you should be able to still get the type of coverage that you need when you need it.
Yeah. This, again, it just points to get some professional advice.
Yeah. Any other common mistakes or common issues when people are signing up for health insurance after retiring before Medicare?
I'd say the big thing that and this is very, very minor, but when we're meeting with people and you're applying for a healthcare plan, like you said, doctors is really important. Prescriptions is really important. social security numbers of the people that you're covering. That can be a thing where we're getting all this momentum, we're getting ready, we're signing up, and then, oh wait, we actually need to pause and we need to go find for the kids, for the wife, or anything like that, because we can't apply for it without those numbers.
Yeah.
The very small type of situation, but
Okay, so have a client who's turned 65.
Mm-hmm.
He's in December. Mm-hmm. He's on his wife's health plan,
Mm-hmm.
and she's going to work for 3 more years. Mm-hmm. They're going to have IRMA issues,
Mm-hmm.
so he would pay a lot for his. And I encouraged him to just stay on his wife's plan if it's possible for the next 3 years. Is that a good idea?
it's a good idea, assuming that his wife's plan is a qualifying health plan in Medicare's eyes, which comes back to that 20 or more employees number. But if that is the case, then I think that's an excellent planning strategy.
Hopefully this discussion has helped you know more of what your options are, what your choices are, and what are the pros and cons so that you can start evaluating each. But hopefully it's also pointed to the clear need for proactive planning wherever you're at in your career and proximity to retirement, but also the need for a health insurance expert that's working with your certified financial planner to help you plan ahead and make great decisions. So Ben, thanks for being on the show. On behalf of Kevin Cohorn, Ben Bulgari, all of us at Cohorn Financial Group, have a great weekend. We'll see you next Saturday for the Wise Money Show with Cohorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Corehorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.